Welcome to Ready Set Crypto. This is your brain on blockchain. So we just experienced the fastest 30% market sell-off in modern history, eclipsing the pace of the 1929 market crash. You know, what's funny is that history doesn't repeat, but it often rhymes. Friday, we saw the Dow rally more than 1,300 points, capping its biggest three-day surge since 1931. Of course, nothing inspires confidence quite like the volatility of 1931, but the $6 trillion question we should be asking is, are we in a classic bull trap? Well, that would seem to be the logical thing considering the forward outlook. Many businesses will continue to stay shut down for months, if not go out of business. Loans will prevent some bankruptcies, but will still have severe negative impact on future earnings as they must be paid back. The thing is, the market is prone to huge swings when a long bull run is ended by a collapse, and that becomes the focal point of so much uncertainty. Just how bad should it be? How bad will it get? And even during all of this, a lot of people are still looking to time the bottom, just as they were looking to time the top a few months ago. So in this video, let's address that. Let's address how you should be responding to this crash and what the market's going to look like in the near future. Now, for those that are looking to take the bearish side of this outlook, you must remember one axiom above all. The market can stay irrational longer than you can stay solvent. Just because you believe it should go down or up does not mean it will do so. Still, Friday was the best one-day gain since 1933, and that should say it all. Some of the biggest one-day gains were during the worst bear markets of all time. Now, stimulus checks and boosted unemployment will drive increased consumer activity, but non-essential industries that are shut down, they won't really see any of that consumer money. And furthermore, what real other positive news comes after this? Cases will continue to explode, states and municipalities will start resorting to more strict and drastic measures, as well as other countries. Let's also consider the very real possibility that federal leadership continues to be less competent rather than more. What I find interesting is that the stimulus bill positively affected the market, but the worst unemployment numbers in a week ever hardly affected sentiments, although volume was low, which could be indicative of a tidal shift in the near future. Look, if you're going to be actively investing, at least read the full text of the stimulus bill. There's a lot the media is not reporting. If you're sticking to a consistent strategy of index investing and not buying or selling, and think you can outsmart the market, then make sure you read the full stimulus bill, as the details are very important. What has been made very apparent is that there's no punishment for company valuation when unemployment rises. Instead, companies will survive because of government bailouts, and the working force will fail because of inflation. Or at least that's how the thinking goes. Long-term, companies need consumers, not the government, to support them. The bill does mean that consumers will be able to pay them for the foreseeable future, but COVID-19 hasn't even really hit us hard yet. You know, sure, people are getting one fiscal bazooka check fired out of a helicopter raining down money across the land, and that level of monetary policy was something only the Yang Gang was cheering on 3 months ago. But people's bills are still due next month, and rent, and 3.2 million people are out of work as of last week. One stimulus check is only a bucket of water when they have a forest fire to fight. That said, it's true that the ongoing relief rally is providing some level of comfort, and maybe COVID-19 will run its course quickly. Maybe the unprecedented stimulus levels will reinflate the 2020 stock bubble anew. On the other hand, the financial markets will need to assess the progress of containing the coronavirus, as well as the bounce back ability of corporations. You know, which ones will go bankrupt, which ones will get bailouts. One question from the stimulus bill is that if the government is getting stock options for a corporation in return for bailing them out, then they have a vested interest in that company succeeding and increasing their share price. Not that they want all companies to do well, but they want a specific company to do well. For example, they could specifically choose a company that they have an equity stake in for government contracts. You know, basically what the US government accused the Chinese government of doing, and there's some irony in that. You know, it's true that assets like stocks are unlikely to head straight back to the stratosphere when the sales and profits of companies are floundering, and corporations like airlines are on life support and need direct intervention to survive. In the midst of a relief rally, nobody wants to think about the prospect of a reversion to the mean in stocks. But we need to consider that the S&P lows from March 23rd might not hold as the number of cases skyrocket across America and investors go right back into fear mode. Consider the fact that total returns for high-yield bonds here in 2020 definitively cracked the Christmas 2018 lows, and that increases the likelihood that the S&P 500 will follow suit. So instead of trying to catch the falling knife, maybe there's another way to fish for the bottom, looking for the recession's midpoint. Here's something that's been true about every previous recession. Risk-taking becomes beneficial about halfway to 2/3 through the period of economic contraction. That's why you don't see high volatility, high risk assets like Bitcoin doing well right now. So if you subscribe to this notion that risk-taking becomes beneficial about halfway through, simply identify the recession time horizon. Easy, right? Well, according to the folks at Oxford Economics, the depth of the recession will be worse than the 2008 financial crisis, but the V-shaped recovery will also be epic in its ascent. The economic downturn began in March, and the expansion may ignite as soon as August. In this exercise, the bottoming would occur around the end of May. Bottom seekers might wish to re-risk everything from foreign equities to fallen angels. Amazingly, in a couple years, we could see that BBB rated corporations that fell into the high yield debt or BB category became some of the best investments of the century. Right now, BBB rated corporate bonds are the Achilles heel of the global economy, and almost half of the investment grade corporate debt is BBB rated, aka garbage, and just one step over the non-investment grade. I can't wait for The Big Short 2 when Margot Robbie in a bubble bath explains how the overly long-term near-zero interest rates led to companies loading up on improperly rated garbage debt that imploded during the pandemic and required a second financial bailout in a decade. And if you think The Big Short 2 is going to be good, just wait for the third one where we learn absolutely nothing and do it all over again. So we need to remember that so long as the number of new COVID-19 cases continue to outpace themselves day after day, no one is going to feel confident or certain in this economy. The next 3 months here in the US are the most critical to ensure we see a remission of the virus by the end of the summer and a potential early market bottom rather than more record up and down days in the market. And here's why that is. A recent analysis from the University of Pennsylvania estimated that even if social distancing measures can reduce infection rates by 95%, we'll still see 1 million Americans that need intensive care. Right now, there's only about 180,000 ventilators in the US, and more pertinently, only enough respiratory therapists and critical care staff to safely look after 100,000 ventilated patients. Here's what's not up for debate. Abandoning social distancing would be foolish, and abandoning it now, when tests and protective equipment are still scarce, would be catastrophic. So here's the best case scenario. If Trump stays the course and listens to the experts rather than prematurely ending policies like social distancing, if Americans adhere to strict social distancing, if testing can be rolled out fast and effectively, and if enough masks and ventilators can be produced, there is a chance that the country can still avert the worst predictions about COVID-19 and at least temporarily bring the pandemic under control. No one really knows how long that will take, but it will not be quick. It could be anywhere from 4 to 6 weeks up to 3 months. And that's directly from Dr. Fauci, who is in charge of the coronavirus response. So that's why we need to see new coronavirus cases hit the top of the bell curve before the economy, not the market, can start to recover. Regarding the market itself, I'm no longer bullish or bearish, just uncertain. The only thing I am certain of is volatility. So here are my 4 takeaways based on the stimulus bill and what I think is going to transpire over the next couple months. The first is that the market cap of all S&P 500 companies is about 25 trillion. And the Fed is injecting 500 billion alone today. And that's a big number, right? Not really. How much of that ends up in stocks or specifically in the S&P 500? I'd guess about 1/20th on the high side, assuming a large chunk of that has to go to supporting mortgages and non-listed businesses. That really only equates to about a 0.1% pump in the S&P, which is barely anything. The second takeaway, and I need you to seriously hear me on this, is that the virus is not going away anytime soon. Not in 2 or 3 months, despite what you might hear. And even if we start to see it go into slight remission, I want you to look around you right now and ask yourself if you'll feel comfortable eating in a restaurant in 3 months. Will you be traveling in 3 months? Now, you'll probably be careful for the next year until we get a vaccine. And I think that sentiment is reflected by many people in the economy. Any small outbreak, even one person, can cause another New York-like pandemic. Remember, this all started with one person. And like I said, we have to get the virus under control before we can recover the economy. Businesses will continue to hurt even if we drive down the cases. So the third takeaway from the stimulus bill is international revenue. If, let's say, the US can somehow bring down cases enough to get people out again, how many other countries will still be on a lockdown or seeing remission? A lot. And now that the virus is a global pandemic, just because we're seeing summer in the northern hemisphere in a couple months, well, the inverse is true in the southern hemisphere where they're going into their winter. And as we know, the virus thrives in winter-like conditions. We still really don't know how it does in summer-like conditions because it's all so new. And so that leads me to my fourth takeaway. If and when this is all over, people are going to be hurting for a long time. They'll have deferred multiple months of mortgage and rent, essentially choking them financially, even once the world is on a pace to coming back to normal. This is why this event is an inflection point that will be felt for generations, just like World War II or the 1929 crash or World War I. It is of that scale, and anyone who downplays that isn't seeing the big picture. So we'll continue to talk about this throughout this week and in the months ahead. And definitely one of the questions we're getting a lot right now is how to respond. What is the best way to invest amid the heightened volatility? I believe it's to make sure you adhere to a systematic process. If you don't have that process that ignores the price targets and predictions, then get one. It was Sun Tzu that said that every battle is won before it's ever fought. And that is so true right now. We're all human. We're going to feel these emotions. Yet abiding by the rules of your process keeps emotions out of your financial decision making, especially during times like these, especially during times of high volatility. So if you need help building that systematic process, if you need help generating consistent returns in times of uncertainty and volatility, I'm excited to announce that we've launched a new service called Ready Set Trade, which is solely devoted to this singular question. How do I generate consistent profits? How do I, for example, make $100 per day consistently? Our goal is to help you create a systematic process that answers that and helps you respond to a time of great uncertainty with a degree of certainty and consistent income. And quite frankly, I don't think we could have picked a better time to bring something like this to you. If you're at all interested, head over to readyset.trade, and to celebrate our grand opening, if you use the promo code LAUNCH at checkout, you'll lock in a 20% discount for life. So be sure to do that soon because we'll be cutting off that discount very shortly. So what do you think of the markets right now? How are you responding? When do you believe we'll get the virus under control? And when do you believe we'll hit the market bottom if we haven't done so already? Let me know in the comments below. And as always, thank you so much for watching. I'm so appreciative of your support of this channel in this trying time. And my promise to you is that we'll get through this together. As always, this has been Ready Set Crypto. I'll see you in the next one. Cheers.